Well, good afternoon, ladies and gentlemen. My name is Trevor Wilkins. I'm from NUS. On behalf of the Department of Accounting, NUS, and the Centre for Accounting Research and Education, CARE of Notre Dame, we're very pleased to welcome you to Singapore and to welcome you to this inaugural conference. First of all, now I'd like to introduce our speaker for the afternoon. I mean, most of you know of, or if you don't already know, Professor Peter Easton from Notre Dame. Peter has been to Singapore a couple of times now, and NUS is very happy to have this association with the Care Centre of Notre Dame, and we are very happy to have Peter here with us for these couple of days. He has a very busy schedule, and we're very happy to have such an audience of people from around the region and from afar to be here, and we hope it'll be very successful in terms of interactions over the next couple of days. Peter will take questions for clarification during his presentation. However, because of the time constraints, and remember we have to finish around about 5 o'clock for the reasons that we mentioned earlier, so we try and limit the questions during the presentations, and then we'll allow maybe 15 minutes after the presentation for sort of questions. But if there's a question of clarification, Peter will be happy to take questions as we go along. Just a little bit of background. I think we've all known Peter. Peter graduated from Berkeley, and his first appointment after Berkeley was Chicago. That says a lot in itself, that he's one of the, his first appointment coming out of Berkeley, a student of Jim Olson, and he went to Chicago. After being at Chicago for a couple of years, he then took a professorship at Macquarie University in Australia. It was very unusual in those years, I think it was in 1988, which is a while ago now, for fairly new young professors to be appointed to a full professor in the system in Australia. But Peter followed in the tradition of a previous young professor with red hair who came from Chicago and went to University of Queensland, Ray Ball. So at that stage, Ray Ball was called a boy professor, but they never called Peter a boy professor. Maybe he looked a little bit older or a little bit more mature and distinguished, but came from Chicago to direct to take back a professor's chair. And over the years, Peter has distinguished himself with his writings, and we've all seen his papers in all the top journals, and he's now editor of RAS and associate editor of CAR, and he's been on the editorial boards of most of the journals, so most of you have had some exposure to Peter somewhere along the line over the years. So without any further ado, I'll pass over to Peter. Okay.
I'm going to say much more in terms of words of thanks to National University of Singapore, to Alfred, to Vincent, to the various people that have made this conference work tomorrow. Now, part of the reason for that is that the Dean is giving some opening remarks tomorrow, and as we all know, it's important to say thank you words when the Dean is present, and since you will be there again tomorrow, I will say those things tomorrow. But the fact that I'm going to delay it tomorrow should not by any stretch suggest that we're anything but extraordinarily grateful that National University of Singapore picked up CARE and said, we're going to have CARE at Singapore this year, when we had decided, because of the state of the economy, which influences CARE in many ways, I'll talk about that a bit tomorrow, to postpone the conference for 2009. So thanks a lot to NUS. I'll say a lot more about that tomorrow. This afternoon, I think you'll see that the description of what I'm going to talk about is extraordinarily vague. Now that means I can talk about almost anything, I suppose. What I'm going to do is split into 3 sessions, and the 3 sessions will talk about, first of all, research in conservative accounting. And you'll see I'll be talking about things that are very different to what you might expect. Bassy may be mentioned, but probably not. And the reason for that is no offence to Sudipta at all, or for the great amount of work that's come out of Sudipta Bassu's dissertation. I just assume that you are aware of that material, and so there's no point in covering things that everyone's already familiar with. My intention is to talk about different things, and to perhaps to, if I can, if anyone can walk away with an idea, that'd be great. That's my intention. So first of all, conservatism. Second, design issues in valuation research or in value relevance research, whatever umbrella, information content research, whatever umbrella you want to put on the mapping from financial statement information to security prices and returns. Now, it's going to come as no shock to you that my emphasis will be on scale. So the second hour we'll be talking about scale, the impact of scale, what we should do about it, why we should care about it, when we should and should not have to worry about it. The third hour will be on valuation research, and it probably comes as no surprise to you that a big chunk of that will be looking at cost of capital. And I'll cut straight to the quick on that. My idea is to, by the end of a half an hour, to tell you at least the way I think cost of capital should be estimated in capital markets research. Because most of you are pretty aware, I suspect, that the existing measures are, and I actually put the word on the slides, dreadful. And so we have to do something to cope with the incredibly bad measures that we've got. And the message that I want people to take away is, don't just keep using these dreadful measures. Let's do something about it. And perhaps there is at least a method that we can use. And finally, I want to appeal to us all to actually do some valuation research. And by that I mean there's a vast profession of people that try to value firms, try to value debt, try to value derivative securities. We as accountants know a heck of a lot about that, and yet we hardly make any contribution to the profession. So that's basically the 3 topics: conservatism, scale, valuation research. So conservatism. What I want to talk about in the next hour is some ideas about conservatism, and I'm going to begin with a definition. The definition, believe it or not, comes out of Stickney, Will, Shipper and Francis, one of the financial accounting textbooks. My textbook does not have a definition of conservatism, which I realize is a shortcoming. So first of all, I'm going to talk about their definition. I think it's an excellent definition. It sort of talks about conservatism as we all talk about it, but also talks about it in a way that makes sense to an MBA or an undergraduate student. And if our research doesn't appeal to that, then we're probably not contributing. Then I'm going to talk about a theory. And I think you all realize that we're in bad shape in accounting, and as much of our empirical research has not been motivated by theory. It's been motivated by stories, some of which are pretty loose. There is a theory, it probably comes as no surprise to you, it's Jim Olson's theory. The date is 2009 for this paper. It's in the current issue of CAR. And I'm going to talk about what Jim says about conservatism. The takeaway from that is it's all about growth. If there isn't growth, there isn't conservatism. If there is conservatism, there may be an illusion of growth that may not be real growth. Then back to Feltham and Olson, now work that's 13 years old. But Feltham and Olson gave us a framework for understanding conservatism that kind of got lost because of the wave of research that came out of Rochester, largely Sudipta Basu's dissertation and everything that came behind that dissertation and continues. So I want to take us back to Feltham and Olson, and then I'll talk briefly about a paper that I have with Peter Vassallo, who's going to actually stand up and talk about that in a minute. He doesn't know that yet. And all I want to do there is just to show you some results that kind of talk about how you can actually use Jim Olson's work to try to really understand the conservatism that's going on the financial statements that we are all familiar with. Then finally, I'd like to look at Penman and Zhang, their accounting review paper, which I think is a great way of modeling and understanding conservatism. People don't seem to have picked up on it, and yet there are a lot of pointers in that paper as to things that we might want to do. So I'm going to point to those things that Stephen and Chao Zhong have talked about. And the two key things are, how does conservatism play into prediction? How does it affect our ability to forecast? And of course, you can see the link behind that. If we can't take into account conservatism, when we forecast the future, cash flow, income, operating income, whatever it is that you're going to use to value the firm, then we're in bad shape. So we had better understand the impact of conservatism on prediction. And lastly, those of you that are familiar with Penman and Zhang will recognize they point out that it appears as if the market does not understand the impact of conservatism on prediction. And so that feeds into trading models, ways that we can make money. And this last one is something that people really have picked up on, the impact of conservatism on trading strategies, and there are several papers along those lines, some of which would couch in those lines, like Joe Piotrowski's dissertation paper, but it effectively was conservatism. I don't know why he chose not to call it that, but he chose not to call it that. So a definition of conservatism, and this at one level is pretty bland, but what is nice about these definitions are that they're not loaded in a methodology. How often when we talk about conservatism as accounting researchers do we talk about a coefficient in a regression of earnings on returns with a dummy variable that picks up positive versus negative? That's not conservatism. It's a coefficient that Basu described as conservatism or timely loss recognition. So we've sort of got to go back to basics. So this is Stickney, Will, Francis, and Shipper and Francis. Conservatism. It's a reporting convention that calls for anticipation of all losses, anticipation of losses and expenses, but it defers recognition of gains on profits, importantly, until they are realized in arm's length transactions. In short, the matching principle. In the absence of certainty, conservatism reports events to minimize cumulative income. In other words, there's a pushing down. Okay? Now, see how this is so much a statement of just what it is, rather than loaded on how we might pick it up empirically. It does not mean reporting low income in every period, and this is something that's extremely important and somewhat absent from the conservatism literature, particularly that based on Basu. This idea that over long enough time span, income is just cash in, less cash out. In other words, the accounting will get it in the end. What that means, of course, is that if income is low now, or in one point in time, due to conservatism, it must be correspondingly higher by exactly the dollar amount by which it's too low now, sometime in the future. So this self-correction mechanism of conservative accounting is something that's not in the literature, but is very much Penman Zhang. That's what Stephen and Chao Zhong's paper is about. So this is the textbook definition. So Jim's idea. Now this is Jim's paper in the current issue of CAR. There are 8 points in that paper. It's divided into 8 sections. I've somehow got 9 sections here, but I'm not going to tell you what's the new one. I'm not sure what it is. He starts with this concept of the savings account, which is actually very simple, but a nice place to start, and somewhat esoteric as it's described. And I want to make this a little bit more intuitively sensible. So I'm going to go through an example which happens to be Procter & Gamble, a real example. Then I'm going to introduce the way that the current earnings and dividends map into future earnings and dividends. In other words, the earnings and dividend dynamics as Olson describes them. All of this is still in a savings account. A dividend notice in a savings account is a withdrawal. We decide to withdraw from our savings account, we pay a dividend to ourselves. Okay. Then we introduce uncertainty. Arguably, at least in Jim's idea of a savings account, there isn't any uncertainty. You make a contract with the bank when you put the money into the bank and you get the money out that you contracted for. But now introduce uncertainty, you might not get everything that you expected to get, okay? Or you might get more. Then we need the concept of permanent earnings and economic earnings. These two things differ in an important way in Jim's analysis. Now, these are all definitions according to Olson. And they are very carefully thought out, structured definitions. At the same time, other people describe economic and permanent earnings in different ways. So these are Jim's definitions. Then we're going to introduce accounting-based valuation into this world, and it's not surprising that we would have residual income and abnormal earnings growth. That's what we're going to talk about here. And then growth. And growth is going to be driven by conservatism. The link between growth and conservatism will hopefully become clear in this theory. And finally, the point that conservatism can continue forever. And this is basically saying that it could be that market value is greater than book value forever. In other words, book value doesn't have to catch up to market value. The price-earnings ratio could be way greater than the inverse of the cost of capital forever. In other words, earnings may not catch up to true earnings over time. This then creates a theory. And the key thing about this theory is that conservatism and growth are the same thing. To use the words from Jim's paper, they are opposite sides of the same coin. You can't have a head without a tail. So here's the model. And I'm going to go through this model in some detail for about 15 to 20 minutes. We start with a simple savings account. And describing this savings account algebraically is extremely helpful. First of all, here on the left-hand side, we've got the earnings dynamics in a savings account. And the earnings dynamics, of course, are simply the mapping from the current to the future. X is earnings. Okay? And in a savings account, if you put money into that savings account and you get a certain interest amount or earnings in period 1, xt, if you withdraw all of that earnings in the first period, you expect to get the same earnings next period. But if you leave some of that earnings in there, in other words, the dividend is less than the earnings, you don't withdraw the whole amount, then you would expect to get the interest, savings account interest on that amount also, and earnings next period would be higher. Now that's the savings account, according to Olson. That's all he means. That's the savings account equation. So X is the earnings from the initial investment. It will be the same next period if we don't leave money in the account. But if earnings are retained, and this is the standard accounting definition of retained earnings, but it means we don't withdraw them in a savings account, then we will get higher earnings next period. And there are two associated valuation formulae. The two formulae matter, and they particularly matter when we start talking about accounting earnings-based valuation in a second. Accounting earnings-based valuation in a second. First of all, the relation between value of our savings account and future earnings or interest is just that future earnings divided by the discount rate. And this is sort of something we all say, yeah, of course we knew that. We teach that in introductory accounting. For sure, we all know that. It's also important to recognize, however, that there is a mapping from current prices to earnings, but that mapping must take into account that out of the earnings of the period, XT, we will withdraw a dividend for that period. So the value of the firm after the earnings has been withdrawn, of course, is not equal to this multiple, 1 plus R over R, or 11 if the interest rate's 10%. 1 plus R over R times earnings, we've got to add in the dividend that accrued to us as a result of the earnings of the period. So the appropriate contemporaneous valuation includes price on the left-hand side. Now, this may appear to be trivial. It's not trivial. And the reason it's not trivial is you will see almost always that if an analyst, for example, talks about a PE ratio, and they're talking about price to current earnings, the multiple is this thing, and they never adjust for the dividends. So that difference is important. It's subtle, but it's very important. Okay? And of course, you can see if this is earnings, if you think about it in terms of dividends being total withdrawals, the intuition starts to become even clearer, I hope. Okay, so let's put some dollar numbers on this. And lurking in the background of this is Procter & Gamble for 2006 and 2007. This is the example that I'll keep coming back to. It is the example in the monograph that is on the CARE and the Singapore website, my monograph on estimating cost of capital. So this is the example that's in that. It's also the example that's used in my discussion of this paper, Olson's paper, in the same issue of CAR. So what I'm talking about now is much what I've already written and is in CAR, current issue of CAR. So the example, suppose it's the case that we've got a savings account, and in the year 2006 we earned $4.16 in interest. These numbers might seem odd numbers, but it's P&G. It's a real company in the background. Okay? We withdraw from that savings account 2006, at the end of 2006, $1.23. Okay? Which in case of P&G means they pay us a dividend of $1.23. Earned interest in 2007 was $4.39. And let's suppose we've got a constant interest rate. Now, if I were to ask you the question, what is the rate of interest, you would have to solve for the interest rate in this earnings dynamics that I set up before, because you know that next period's earnings is equal to this period earnings plus the retained earnings from last period grown at the interest rate. And so you would solve that and you would find that R for P&G is 7.9%. Okay? So this, if you like, is the cost of capital. That's where we'll be going in the last session. Okay? So this is Jim's idea of a savings account.
Does this include the share repurchases, or is it cash dividends?
Our dividends is all transaction with shareholders. No. So it's going to be repurchases and new stock issues.
Clarification question. What if for last one, say XT is negative?
No, you can't get negative interest on a savings account.
This formula suggests would be negative.
No, you can't get. You can't get. Would you invest in a savings account with zero negative interest?
Yeah, in the favor concept, but I'm thinking about it.
No, let me get there. Let me get there. It's very important to recognize we're in a savings account. We're still in a certainty world here. Right? No, I'll get to your question. But it's extremely important to recognize we're in a savings account here. Okay? In other words, we're still in certainty. We know, in other words, at the beginning of 2006, we're going to get $4.16. We know the next year we're going to get another 7.9%. And we can decide to withdraw. That's the world we're in. But I'll talk about the negative. It's a good question. What happens if earnings is negative? We'll get to that in a second. Okay. All right, so what's the value of the savings account? Again, putting numbers on this algebra. Well, next period we expect to get $4.39. The interest rate 7.9%. Any one of us would calculate immediately the value of the savings account, or the amount we must have deposited, is $55.60. Okay. And the mapping from current prices to current earnings, $4.16, is again 1 plus the interest rate divided by the interest rate, but we must add in the fact that we withdrew $1.3023 out of our earnings over the period. Okay. So this is the savings account. Now we're starting to walk down the path that Charles was talking about. Now we're introducing uncertainty into this world. Okay. We've got the same earnings dynamics, but now unlike a savings account where you make a contract with the bank and you know what you're going to get, when you invest in a firm, you don't know what you're going to get. You've got an expected rate of return, and we're going to stick with the P&G example. You've got an expected rate of return of 7.9%, but you might not get it. And we introduce this shock, this additional amount of earnings, or the smaller amount of earnings via this residual epsilon. Okay. So this, again, Jim's algebra. Okay. So our earnings dynamics then are represented by this now equation with uncertainty in it. This equation with now uncertainty in it. Okay. But we also need to know how dividends evolve over time, and we've got a very generic evolution of the dividends over time. And the fact that it's generic doesn't matter. This can become clear in a second. These coefficients relating current dividends to future dividends and current earnings to future earnings, theta 1 and theta 2, must implicitly be the dividend policy parameters. In other words, are the part of current dividends that you take out that in turn don't affect future dividends. But in turn, if you take out a current dividend, you will affect the earnings of the period, and therefore through theta 1, you'll affect the dividends of the next period. Okay. Now, what's interesting about the dividend dynamics is the valuation formula down the bottom here, and here's a point where the people at the back might decide to take the seats at the front. The valuation formula remains unchanged. Price plus dividends is still a multiple of current earnings. And of course, you should look at that and say, that better be the case. You know, otherwise, Modigliani and Miller, 1956, would be violated. So it's got to be the case that in this model, M&M holds. In other words, theta 1 and theta 2 do not impact that valuation. They're not there. Right? In other words, if you wanted, and of course Jim goes through this in the appendix, if you wanted to derive the valuation model that's implicit in these two time series models, dynamic models, then it would not involve the policy parameters theta 1 and theta 2. Okay. So now, back to our example, we invested in this savings account that P&G is lurking in the background, but the savings account was expected to earn us $4.44 in 2007, but expected $4.39, but actual $4.44. In other words, there was a shock of 5 cents to earnings. We got 5 cents more than we expected. This $4.39, the earnings that we expected to get at this point in time, remains as the permanent earnings. This is the expected permanent earnings going forward in a Jim Olsen world. Okay? And it's central to his valuation. It's important that we understand this permanent earnings concept. There is another earnings number here. It's actually the 444, and that's called economic earnings. We'll get to that in a second. But notice that it doesn't matter, and of course, hopefully intuitively, this makes perfect sense to you. It doesn't matter that we've got a shock occurs. The valuation at the beginning of that period, of course, is based on expectations at the beginning of the period, and hence the value is unchanged. Okay? So the valuation model is unchanged. Price is based on permanent earnings, not economic earnings. Okay. Now if we introduce economic earnings. Economic earnings requires price equal to book at all points in time. Okay. And I'm going to describe what I mean by this. When the first time you see this, you think, no, that's not what I think economic earnings is about, but it is. It is what it's about because economic earnings is anchored on true value. And in this world, we assume that price is the same thing as true value. Okay? So, earnings of the period is just change in price plus dividends. In other words, if we invest in IBM and IBM doesn't pay us a dividend, but the price goes from 100 to 110, earnings is $10. Okay. Of course, since price is equal to book at all time, it's also change in book plus dividends. And importantly, next period earnings is just the cost of capital times book. And of course, you can see residual income is starting to sneak into the model here. Because in an economic earnings world, the residual income is zero. Okay. To put an example on this, now again we've got P&G in the background here. P&G's price at the end of 2006, end of its fiscal year 2006, was $55.60. The dividend it paid for 2007 was $1.41. Its price at the end of the period was $58.63. Its economic earnings, therefore, was 58 minus 56 price change plus the dividend of the period, or 444. That's its economic earnings. The permanent earnings is still what we expected to get at the beginning of 2006, or 439. The surprise is the 5 cents.
In the previous slide, you indicate that economic earnings requires price per book value. But in the P&G examples, does this require the value? Is this require the value?
Yes.
So, given that, can we still apply this principle?
Yes. The question was, in the P&G example, is the assumption that price equal to book violated? The answer is yes. P&G don't always. I think you're saying it must be. You're preempting my answer, I think. Obviously, we all know P&G don't report market value as their book value, so it is violated, right? Then the next question is, does this still hold? And the answer is yes, but now recognize that what we're looking at here is still, and this is extremely important, economic earnings, right? So at this point in time, we've introduced no accounting, right? Okay. P&G is not going to report 444. You know, otherwise we'd just pick up the Wall Street Journal and we'd know everything. We wouldn't have a need for an annual report. P&G is not going to say when it reports its book value of common shareholder equity, it's 55.60. Otherwise, we wouldn't need the balance sheet. Okay. Did I answer your question?
Kind of, but economic earnings you can calculate, what do you have formula? You can always plug a number into the formula.
Yeah, but let me.
The question is whether this formula makes any sense.
Well, it's.
Given that the requirement is not whole.
The question is, does the formula make any sense? The answer is absolutely yes, it's a tautology. This is all definitional at this point. But in a second, I'm going to introduce accounting. Right. At this point, we haven't got any accounting in here. Price and book value are the same thing by definition. Right. Economic earnings are and accounting earnings are the same thing by definition. We've got a savings account with uncertainty introduced. Okay. Now, you'll be pleased to know we're going to introduce accounting. And the first thing that Olson points out is this cancelling error theorem, which sounds very fancy, and it took me 20 years to know what Jim was talking about when he talks about the cancelling error theorem, but it is incredibly straightforward. And here we've got an example of the cancelling error theorem at work. Okay. Now, to answer Charles' question, the price for 2006 for P&G was $55.60. The book value, straight off the balance sheet, take the book value of common equity, divide by number of shares, was $20.16. The goodwill, therefore, economic goodwill, is $35.44. Okay? So we do get this disconnect between price and book value. We're no longer going to have economic earnings. Okay? Now we're going to introduce accounting earnings. Okay? Now, the expected dividend, $1.41. That's not an accounting number. That's just what we expect to get paid as a shareholder. The expected permanent earnings is still $4.39. That hasn't changed. The expected book value, $23.14, if, and this is important, will report expected earnings, permanent earnings, expected permanent earnings. Okay? The expected price at the end of the period is just the price at the beginning, scaled up by 7.9% cost of capital, plus the dividend, $1.41, and minus the dividend, the expected price, $58.58. And what's important in this example, notice the goodwill at the end of the period is the same as the goodwill at the beginning of the period. Price is not equal to book in this example. Price is way greater than book. Price is way greater than book. But earnings is still perfect. Okay? In other words, this cancelling error theorem points out that we can have a book value that's way, way, way off, but earnings can be perfect. Okay? That's the cancelling error idea. Okay? So goodwill may not change over time. Okay? Now again, we're still sort of setting up the basis of the model. Now let's get an accounting-based model. And there's a massive algebra up here, and now I'm really testing your eyesight at the back, and there are still 4 seats at the front here if you'd like to take them. In all of these models, we begin with a DCF, dividend capitalization model, or we begin with dividend capitalization, one or the other. Discounted cash flow or discounted dividends. Discounted cash flow is where we're beginning here. And then Olson introduces this neat little trick that defines 0. 0 is A minus A plus B minus B plus C minus C, right? That's what 0 is equal to. And so 0 is equal to Y minus Y. Y1 minus Y1. Y2 minus Y2. And what's important about this formula is Y is a valuation anchor. And by that I mean it's either the bottom line of the balance sheet, book value, or the bottom line of the income statement, capitalized, that is earnings, capitalized. Okay? So Y is one or the other, and you'll use the same valuation model to derive residual income, where book value is the anchor, or abnormal earnings growth, where earnings is the anchor. Okay? Exactly the same. And all that you do, and the algebra is incredibly simple, is just add equation 1 and equation 2. Sum them and collect terms. Okay? Now you collect terms and you get this valuation formula. Value is equal to the anchor. And the anchor is either book value, if it's residual income, or capitalized earnings, if it's the abnormal earnings growth model, plus an adjustment for the conservatism in accounting. And remember, the message here is all about conservatism. So this adjustment here captures the conservatism either on the balance sheet or the conservatism on the income statement. Okay? Now, if we've got residual income, Y is just equal to book, and you'll see that we quickly, from this equation, this generic equation with any anchor, we get the residual income valuation model that most of you are familiar with, I suspect. The anchor's book value, and then we've got the residual income adjustment. This immediate transformation is residual income's not immediately obvious, but if you take into account clean surplus accounting, you immediately get residual income valuation. Same algebra, same steps, only instead of substituting Y equal book value, Y is capitalized earnings, and we get the abnormal earnings growth valuation model. Okay? But the key thing is, all of this stuff sitting out here, is growth. It's driven by the conservatism in accounting. If it is the case, going back to Charles' question, if it is the case that price is equal to book value, there is no conservatism, there is no growth. So you can see the sort of message that's the mantra of Jim's paper and maybe the mantra of this talk. Growth and conservatism are the same, two sides of the same coin. So let's put some numbers on this. Jim writes the residual income valuation model in a slightly different form. I guess Jim's allowed to do what he likes, but it creates some confusion, and I'm going to walk down that confusing path a little bit. You can express the residual income model in a slightly different form. This different form only differs in as much as the growth piece is a multiple of the valuation anchor rather than an addition to the valuation anchor. But it's not immediately obvious that this is a form of residual income, but take my word for it. Okay? It's actually derived very carefully in his appendix. Now, if you look at this residual income model, which can be re-expressed in the form we've got here on the right, and of course that part's pretty obvious, right? ROE is just book divided by earnings divided by book, right? You can very quickly re-express residual income as growth in book, okay? So notice that what we've got here is just growth in book. But as always, we have to add back in the dividend. We always have to add back in the dividend, otherwise we're not comparing apples to apples, right? There's something genuine about the dividend that will be taken out next period that is part of growth, okay? So here we've got growth in book value, but the growth in the short period, notice this is growth from just time 0 to time 1. This is just short-term growth. But then we grow from that base even further, okay? So we've got short-term growth, and then we've got this perpetual growth that we see in all of our valuation models, in all of the derivation of cost of capital, implied cost of capital papers. We've got the growth from this short-term growth base, okay? So the message out of this version of the model, conservatism in accounting, and again we've got the P&G numbers, the ROE is 14.8, so short-term growth is 14.8%. The growth in residual income from that base is almost 4%, 3.96%. So we've got short-term growth at 14.8%. We've got long-term growth at almost 4%, 3.96%. And importantly, notice that given that both of those growth rates are positive, we've got price greater than book. So our market-to-book ratio is 2.76. And that 2.76, which we all see as conservative accounting, the balance sheet is pushed down, is low, is a function of short-term and long-term growth. Okay. Now you can do the same thing on the income statement. And now, of course, and it's important to recognize, of course, these are accounting earnings we've got in here now. Do the same thing with the income statement, the same thing with the abnormal growth in earnings model. And again, like the residual income model, this is the multiplicative form, not the additive form. And notice that here is next period's earnings capitalized. So this is the valuation anchor. And then we've got short-term growth from that base, and we've got long-term growth. Okay. Now notice that in determining our short-term growth, we compare current earnings, that is period 2 earnings, with period 1 earnings, so that's growth in the earnings number. But again, we add in the dividend. So earnings would have been higher next period had we reinvested the dividends. So here we've got the short-term growth in earnings. That is the growth from period 1, when we've got the anchor, to period 2. That growth is 17.8%. Real high. Okay. Now because this growth is so high, we can't sustain this growth at 17.8% forever. In other words, the fact that this number is way low, 2.99, remember economic earnings was 430. So we've got conservative income on the income statement. The fact that this is way low is caught up too much in the first period. We get massive growth from this base, the 17.8% growth. We can't keep growing at 17.8% or we'll overcompensate for the gap between capitalized earnings and price. And so we've got a negative growth rate in the long run. Okay. So as short-term growth, again, we've got short-term and long-term growth. Short-term growth from the earnings base is massive 17.8% in the case of P&G. And then the long-term growth from that base is a negative 13%. Okay, yeah, okay.
What's the adequate proxy for long-term growth? How can we capture that? How can we measure that?
The question is, what's the proxy for this long-term growth number, this gamma, or the 13.1%? I don't have one. But what I can say, and I'll come back to this at 5 o'clock this afternoon, in practice, most people, the most popular method of estimating the implied expected rate of return, cost of capital, assumes this growth rate is 0. Assumes that gamma is 0. Here's a real example, P&G. The numbers that I've got here came out of value line forecast for P&G. The cost of capital came out of Bloomberg. So these are fairly reliable sources. And the implied growth rate's 13.1. In other words, to assume that it's 0 is heroic. If I knew what it was, of course, or had a good proxy for it, it would be almost the Holy Grail. But I'll actually talk a lot about that this afternoon, later this afternoon, because this assumption that that growth rate is 0 is an assumption that everyone seems to make, at least when they use what is referred to as the Easton 2004 method of estimating the implied expected rate of return. And I'll be quick to point out that the purpose of that paper was to say, don't use that method, yet people use that method. So it's a long answer to your question, I think. Okay, now we want to introduce real growth into this model. Notice there's nothing here that suggests anything's happening other than the accounting's conservative. That's all that's happening. There's no real growth. It's all growth due to conservatism. Okay? In other words, if price was equal to book, if economic earnings and accounting earnings were the same, there'd be nothing sitting out here. There would be no growth. It would be 0. Growth in the short run and in the long run would be 0. Okay? So far we've got no real growth. And the way that Olson introduces growth, as many of you know, is to introduce other information, something else outside of the accounting that picks up growth. Okay? Something that picks up growth. And he introduces that via another information variable. And growth then is captured in the mapping from this thing that summarizes the current state and the summary of the current state in the next period. So this is a 1 plus growth rate. So gamma picks up the extent to which these other things in the economy, firm-specific things that are affecting the transition of the firm from its current state to the future state are captured by this variable gamma. Okay. Now, in terms of just focusing just on the normal earnings growth model, because I'm going to bring the focus all back to earnings. Here we have the abnormal growth in earnings model, now with additional information in it. And what you see is that introducing V, this other information, into the model, and admittedly I'm going fast here. I've tried to be more detailed to this point, but I'm aware I'm running out of time. This growth variable, growth in this information, the growth variable gamma, is this growth variable that's the perpetual growth formula variable in the abnormal earnings growth model. It is the information dynamics that causes this real growth in earnings over and above accounting conservatism. Okay. Now, can this conservatism continue forever? Yes. Price can always be greater than book if residual income's positive. The PE ratio, or the EP ratio, can be greater than the cost of capital. In other words, we don't have economic earnings, if abnormal growth in earnings is positive. And you see that in the example that I've set up for P&G, a normal growth in earnings was 17.8% in the first period. It will continue to be positive, but it will fade from 17.8% to a much, much lower level in the future. Okay. So conservatism will continue. Now, what does this all boil down to a practical matter? And how should this affect our empirical design? Now we're moving into a Feltham-Olson world, which uses all of the same principles that were in that Olson 2009 paper. The Olson 2009 paper is a very nice pedagogy for now going back and seeing Feltham and Olson. I've been an Olson student for 30 years, and it's nice to have Olson 2009, because now, with the benefit of Olson 2009, you can read Feltham and Olson 1996. Quite seriously, the pedagogy in that 2009 paper is spectacular in helping understand how you would read 2006. Okay. All right. So there are two practical issues. First, there are two kinds of conservatism. One is conservatism associated with non-zero, we usually think, positive NPV. And the basic idea here is one could never expect earnings to capture positive NPV the day we invest in that positive NPV project. Okay? It will affect market value, one would assume, when you invest in that positive NPV project immediately, but it won't affect earnings and book value until you get the benefits that accrue from that positive NPV investment. Okay? So that's going to push our earnings down for the period because we're making the investment early on. It's going to push our book down in the period because we've made the investment and the benefits haven't accrued. So that's going to be one form. And an example within P&G, I've tried to maintain the P&G example. I tried to in that car discussion. The example for P&G is when P&G invested in Gillette in 2006, they acquired Gillette on a stock-for-stock basis. They gave a share of P&G to every share in Gillette. But they paid $57 billion for Gillette, a huge acquisition. Warren Buffett said, this is just a dream. Now, I think if Warren Buffett says this is a dream deal, I think he means it's a positive NPV investment on the part of P&G. If Warren Buffett's right, as he tends to be, although things haven't gone so well in the last 12 months, but if Warren Buffett's right, then he's basically saying this means this is a positive NPV. And he's going to put his money where his mouth is. 6.4 million shares, Buffett's going to buy at $57 a share. Okay. The second, and PEG is an excellent example of this. We all know, of course, at least in the United States and in general, R&D is expensed, not capitalized. Expensing R&D, of course, means that we take the expense earlier than the benefits accrue from the investment in the R&D. Hence, book value is going to be way low in the period because we've got no R&D asset on the balance sheet. Also, earnings is going to be way low during the period because we take all the expense during the period. So R&D is a great example of the numbers are going to be pushed down in the current period because of conservatism in accounting. What's the effect? Positive goodwill. No reason why price won't always continue to be greater than book for P&G, and the PE is going to be greater than the expected rate of return. In other words, we'll have income statement and balance sheet conservatism. So using that theoretical basis, out of which the message I hope is pretty clear, it's all about growth, is the message. Some new empirical directions that I'd encourage people to think about, although we're all allowed to be a bit biased here, so I'll admit the bias. First of all, starting with Olson, and many of us are familiar, even if we've never read any of Olson's work, we've seen this model which has been attributed to Jim. And this just says that we can argue that price is a linear relation, linearly related to the bottom line of the balance sheet, book value, and the bottom line of the income statement, earnings. And Feltham and Olson, which is the paper about conservatism, conservative accounting, there's no conservatism in Olson 95. The conservatism is introduced in Feltham and Olson, 1996. There's no conservatism in this model. The conservatism is introduced in Feltham Olson 96. And he introduced it in two ways. First of all, we've got the positive NPV piece, which comes through if investments during the period are in positive NPV projects, the coefficient relating those investments to prices should be positive, because the investment here overstates the understates the impact on price. So we invest here, it's a positive NPV project, the mapping from the cash investment to prices is going to be positive. If we're in a negative NPV, the coefficient will be negative. Okay? And it seems to me, if you sort of think about that, and the example I'm going to give you in a second is a trivial extension or manifestation of this model, but there's an endless number of analyses that can be done based on that simple point. The conservatism on the balance sheet, excessive depreciation, LIFO versus FIFO, expensing R&D, expensing advertising as opposed to capitalizing some of advertising. All of these are captured in the balance sheet entering the period is too low. Now, why do we take the balance sheet entering the period? Because conservatism during the period is captured via the earnings of the period. So the balance sheet going in. So we would expect to see a positive coefficient if we've got conservative accounting on this beginning assets, and we would expect a positive coefficient if we've got positive NPV. Now, the paper that I put in the book, and this is a paper joint with Peter from the University of Melbourne, who's sitting up the front here. What we did in that paper, and forgive me, I notice there's a typo here, it's not in the paper. There's a typo here, it should be lagged operating assets. What we did was, we were interested in whether it's in fact the case that capital expenditure, that investment in R&D, that investment in advertising expense, and investment in acquisitions are positive NPV. In certain circumstances, in general. Okay? This model of Olson's allows us to do that. Now, in the second session, and we're running out of time, we all need a break here in a second before we get to the second session. In the second session, I'll point out that we shouldn't run this regression. We've got to run it in a first differences, returns, price deflated world. But it's the same basic model, just in first differences, deflated by price. We're still interested in the same coefficients. And here's what we found. Now, I'll come back to this negative coefficient here. My co-author is going to defend that in a minute. It should be positive. His defense, he told me before we started this session, was it's statistically significant, but it's economically insignificant. Let's just leave it at that. I think that's a good argument. Obviously, that needs further investigations, but it's beyond the point I'm trying to make. We get positive NPV on each of those investments. On average, investment in R&D, in capital expenditure, advertising, and acquisitions is positive NPV and statistically significant. The R&D is marginally significant. Okay. Now, there are many things you can do with this. For example, we petition on the degree of conservatism. So if you've got very high price to book, very high book to price, right? Low price to book. In other words, not much conservatism on the balance sheet. You wouldn't expect much action, and you don't. If you've got very high price to book, in other words, the divergence between the balance sheet and the market price is very high, you would expect much more conservatism. And even at the back of the room, you can see there's a lot of stars down here. There's no stars up here. Okay? So the significance is down here. The significance is not here. So here we've not got very little balance sheet conservatism. here we've got a lot of balance sheet conservatism. Okay? And we also partition it in between profit and loss firms. Okay? Now, what we find doesn't matter at this point, but I mean, I think because we're out of time, and I've got other things I want to talk about for a second, but you can see that you might well be interested in whether investing in R&D, advertising, new capital expenditures, acquisitions, is positive NPV in a circumstance where the firm has made a loss for the period or where it's made a profit for the period. This is the one that we talk about in our paper, but you can see that there's an endless number of things that you could talk about. Okay? Now, I think the strength of this model, as I said, Bassu's kind of lurking in the background, and Bassy should not be dismissed by any means. Okay, I want to talk about the 5-letter word in accounting, scale. So for the next hour or so, I'm going to talk about some issues related to scale, and I think at the end of the 50 minutes or so, you'll come to the conclusion that scale really matters. It really matters. What can we do about it is not so obvious, but I think the message I hope that you take away is we better care about it. And we better think carefully about it in our analyses. Otherwise, we might well have a result that's all driven by scale and not by anything fundamental or anything that we're interested in attributing to the results of our analysis. And I'm going to start to make that point using a sledgehammer. In other words, the next point is not going to be subtle by any stretch of the imagination. The first point, I mean. First of all, I'm going to talk about what is scale. This might sort of seem to be somewhat trite, but part of our problem is that I don't think we've defined scale very carefully. And if we do agree on a definition of scale, I'm sure there are people in this room that will disagree with what I call scale. But till we do get a sense of what scale really is, I'm not sure that we can solve it. And to solve the problem. And I'll talk about what I think scale is. It's just my opinion. I'll then point out that if you buy my definition of scale, you'll see scale really matters. Because most of our results in price levels or market cap level regressions are purely scale. There's nothing else going on. And that's a very strong statement I just made. But I'll demonstrate that, I hope, via some data. Then I'll look at the scale effect, and this again is my definition of scale effect, but I talk about something that's different to scale and scale effect, because there are two different phenomena going on. What labels you put on those doesn't matter, but that there are two different phenomena does matter. Then I'll look at scale in a return earnings regression, because to be fair, most of my criticism of scale has been of price levels regressions, and as you probably know, I've done return regressions and advocated using return regressions, but scale's an issue there too, and I want to talk about that issue. And then finally, scale and thresholds. My talk tomorrow morning will be about earnings management around thresholds. And so I'll only just briefly talk about this last point. But those of you who know my paper with Cindy Durchie in 2005, one of the points in that paper is the kink that we thought we saw at zero is probably not a kink. It's probably driven by scale. It's not due to earnings, it's due to scale. So this is the message, a summary of the message. So first of all, what is scale? These words I've chosen or written here are very carefully chosen. It is difficult to find an argument that supports any other measure of scale other than market cap. Now, notice I don't say scale is market cap. What I say is it's hard to argue that anything other than scale, market cap is scale. Okay? Because if you start to talk about any other variable, which past research has done, past research has identified some empirical measure that they're going to use as a deflator to pick up scale. But if you look at that scale measure and you say, why are you using that measure? It's pretty hard to suggest that current market capitalization wouldn't be better. So if you use book value, for example, or net operating assets, or think of an income statement number, sales revenue, what are you trying to proxy? You're trying to proxy for value. Well, I think you would argue, every one of us would argue, I think, that market cap, though it's got its problems, even if the market's inefficient, is probably a better measure of scale than is book value. Okay? And if you want a homogeneous measure of scale, you probably want a balance sheet or a wealth measure, market cap, rather than an income statement-based measure like sales. Now you'll see if we get to it, and I suspect we won't get to the very last slide, but so I'll preempt it right now. You could say, well, let's use some other measure. Well, what is the other measure? And I've searched a lot for this other measure. The only one I can come up with is number of employees. And if I use number of employees in any one of these analyses I'm about to go through, I get the same result as if I use market cap. Now that should be no surprise because it's highly correlated. Okay, so empirically you're going to get the same result. So at the end of the day, my point is, you might be able to argue that there are other measures of scale, but it's hard to measure that they're better than market cap. That's not to say market cap is scale, but boy, it's awfully close. And as a matter of fact, from now on, I'm going to behave as if market cap is scale. Okay? Because I really think, and I've said this before, if I were to have asked my mother, what is scale? What is the size of a firm? And my mother knew nothing about financial accounting, so far as I could tell. She would have, I think, told me something like that meant the value of the firm. I think she would have. In other words, it's sort of a common sense measure too, I think.
Market value of the firm, but empirically people tend to use market value of equity. The firm, because you have more than equity, yes.
Yeah, I think the question is, should it be market value of the firm or market value of equity? That's not exactly the question, but it's more or less the point that the question asks. If the analysis is of equity, I think it's market value of equity. If we're talking about the firm and firm attributes like NOA or operating income or free cash flow, those things at the firm level, it should be net operating assets, or total assets, whatever you want to call it. But it's market value of total assets, so it's going to be the value of equity plus value of debt. So in other words, it's market value at the end. Similarly, if we're looking at a per share level, it should be price per share, not book value per share, sales revenue per share, or whatever. It should be price per share. And all of the analysis I'm about to go through, which talk about at the firm level, in other words, using market cap, could also be applied at the per share level. Your Berkshire Hathaway trading now at, what is it, about $50,000 a share? Berkshire Hathaway is obviously going to dominate any regression, even if you deflate by number of shares outstanding. Okay. Now, and if you look at the previous proxies, Andrew Christie, in the paper on scale, written now 22 years ago, the point he made very clearly is it's got to be market cap. Or if you've got change in price per share in the numerator and earnings as dependent variable, then it's got to be price per share. Now, in the Christie world, it was lagged price per share because he wanted return as a dependent variable. But that was a particular situation. And of course, if in general you want a measure of scale, you want today's measure. You don't want a year ago. Okay. Barth and Caliper suggested a number of variables. They actually, first of all, suggested the amount originally invested in the firm. These are the words in the paper. Of course, they can't have meant that. For Dell Computer, it's a garage in Michael Dell's backyard, right? So that's not what they must have meant. They come up with some empirical measures, total assets. Well, total book value of total assets, I'd argue market cap's got to be better. Sales revenue, it's an income statement item. the variability of that across firms seems to be too great to me for it to be a benchmark for scale that's any better than market cap. Book value, net income, number of shares, etc., I'd say are not valid measures. Share price is market cap at the individual share level. Brown, Lowe and Lease argue for lagged market value. Frankly, I don't get it. I don't understand why you would use lagged market value, just deflating everything by lagged market value, when in their framework you might as well use current. Why would you use an old measure? And in the paper I'm going to talk about in a minute, I suggest market cap and price per share. And if you want a written articulation of what I've just said, this jar paper that I'm going to talk about in a second articulates this point. Scale matters. And here's the sledgehammer demonstration that scale matters. Here's the regression that we've seen many times in the literature. It is attributed to Olson. Many people call this the Bath regression, B-A-R-T-H, obviously because Mary uses this regression a great deal. Now, in that paper, what I said was, well, okay, this regression could be re-expressed by just dividing through by price. Okay? So the variability in this regression is the variability in the book-to-price ratio and the variability in the EP ratio. And at a reasonable level, of course, you could nuance this and suggest reasons why it's not quite as simple as I'm going to suggest. But recognize you could split or reverse split all stocks so that they were trading at $1 a share. It would make perfect logical economic sense. Okay? So economically, you can re-express the value of every firm in terms of $1 per share has an equivalent amount of book and an equivalent amount of earnings. And so economically, this regression makes as much sense as that regression. Now, you can, as a matter of fact, run that regression, though that's not the point I want to make at this point. Okay? So please don't look at that regression and say it doesn't make sense, because it does. It is just weighted least squares, where the weight is the square of price. Okay, so this regression, and this is just to make the point, can be re-expressed as $1, which is the measure of scale, but all firms here have the same scale, is regressed on a book-to-price ratio and an EP ratio. Now, reintroduce scale, we get back to that equation. So this equation 3 is a representation of the first, where scale is just price. Okay, so you've got to come back and buy my argument that price is scale, or it's the best proxy that you've got. Okay, so this is the regression that many people, and the paper that was the basis of this 98 paper of mine, the paper actually did. Okay, so this is just scale, price, on earnings, which is scale, on book, which is scale times book to price, and earnings, which is scale times earnings to price. Okay, so that's the regression that many, many people have run. Now, what I did was I shuffled this book to price ratio and the earnings to price ratio, and then introduced price of another firm. Okay? So the regression that I ran looked like this. The price was IBM's price, for example. Okay? The book to price ratio was Berkshire Hathaway's book to price, for example. And the EP ratio was Coke's. Okay? So what I've done is I've just shuffled all these numbers. So BP could be anyone's BP. Earnings to price could be anyone's earnings to price. And then I multiply everything through by scale. So the scale is someone else's scale. Okay? Now the only thing that these three variables have in common is scale. Okay? There's no economic connection between the book value of Berkshire Hathaway and the price per share of IBM, or the earnings of Coca-Cola and the price per share of IBM. Okay? Now, these are only examples. So if I've got 2,000 firms, I've got 2,000 randomly matched triplets of variables: scale, book to price, and earnings to price. The results are amazing, at least to me. Here is the regression run on the unshuffled data. And of course, I ran it for every year for which I had data, 1963 to 94. Did what we all do. Farmer, Macbeth, average mean coefficient and standard error based on the mean. So here's the raw regression, no shuffling. Here's the regression with the shuffling. Okay. Now, to all intents and purposes, the results are the same. Okay. In other words, earnings has incremental explanatory power over book. Book has incremental explanatory power over earnings. But both have explanatory power for prices. It's all spurious. Okay. The only thing in common between this variable, that variable, and that variable is scale in the second regression. In other words, I think this demonstrates without any doubt that one should not run this regression because all you're picking up is scale. Okay. Now, as an interesting aside, if you buy Olson's model, these variables even look better than here. In other words, we've got an improvement, not a decline, because in Jim's stuff, the weight on these ought to be somewhere between 0 and 1. So we've got a 50% weight on the book value. The coefficient on earnings should be 1 minus this, again 50%, times 1 plus r over r, or 11. So we get almost perfect estimates of the coefficient if we just shuffle. Okay. In other words, doing it this way, accounting seems to add some noise. That indeed might be interesting, but it wasn't the original question that was asked. This is not a complaint. Don't misinterpret me at all. But there are many papers like this that get totally ignored. There's no good news in this paper. It's terribly bad news. But similarly, there's a paper by Gay, Cathari, and Watts that shows that if you randomly partition total accruals, just randomly split them, and call one random piece discretionary and the other random piece non-discretionary, you can replicate many earnings management papers. That paper also has been ignored because it has very bad news. Now, I'm not the least bit concerned about being ignored. That's absolutely okay. At the same time, you kind of ignore these papers at your peril, it seems to me, because we all know this result. And so I just sort of bring it to people's attention. This is the sledgehammer that says scale absolutely matters. Now, what's the scale effect? This is the paper with Greg Summers that was referenced in the readings on the website. What this paper talks about is scale is something quite different to the scale I've just talked about. It's the overwhelming impact of a handful of observations. If you think about Berkshire Hathaway trading at $50,000 when these days most stock, what is the average stock price? It's got to be more like about $1.50, I suspect, in the United States. Seriously? I mean, it's getting awfully low. But anyway, something like 40,000 times the value of any other share or the average share. You can appreciate that Berkshire Hathaway could drag the line around, regression line, because it's sitting way out here. There's a cluster down here. It's going to be the tail wagging the dog, right? That's what this paper's about. Now, the previous literature on scale, and the paper I'm referring to is Barth and Caliper, and many of you know Sanjay reasonably well. The Barth and Caliper paper can be described basically in this sense. If you've got a simple regression, regressing y on x, the scatter plot looks like this. In other words, these green lines represent the scatter plot of the observations. The numbers are all in here somewhere. That's heteroscedasticity. In other words, increasing variance of the residuals as the value of the dependent variable increase. Okay? In other words, a residual is a function of the regression variables. What we show is not that, which is the basis of the Barth and Caliper paper, which is the key econometric paper published in Carr, I think, in '96. What we show is this. The scatter plot looks like this horn shape. And forgive me, this is my effort at artwork, but you can get the picture as to what I'm trying to say. Instead of the scatter plot surrounded by these green lines, the scatter plot is this horn shape, where you can see that the relation among the big firms, Berkshire Hathaway, or if we're looking at market cap, IBM, Merck, Pfizer, etc., is these firms are on a very different line to these firms. So we get this tail wagging the dog. In other words, if you run the regression, what you're going to pick up is the relation between whatever the variables are for Berkshire Hathaway, or for IBM, Merck, Exxon, etc. Okay? And we demonstrate that just by looking at the squared residuals. And basically what we do is just average studentized statistics, studentized residuals. And we do that for the whole regression, but we look at the residuals for 40 groups based on market cap. And you can see that the residuals, which are going to be the extent to which they drag the regression line, are very, very different for the high market cap than the small market cap. In other words, we get this dragging the line up or down. The horn could be the opposite direction, but dragging the line by the big firms. Now, this graph would suggest, okay, just wipe those guys out. The problem is, if you wipe those guys out, the next guys kick in and do the same thing. Wipe those out, the next guys kick in and do the same thing, and so on and so on and so on, until, quite seriously, the sample's gone. Okay? So we do have this undue influence due to scale, which the moral in the story, scale. In other words, you've got to divide by price. Now, just to make the heteroscedasticity point, this is just the average value of those residuals. Okay? In other words, you permit a nonlinearity. If you look at the absolute value of the residuals, that's heteroscedasticity. Okay. Now, again, you do get heteroscedasticity. All that this graph is saying is that you get this green shape. Okay. So scale matters. So we have to divide by scale, by price. That was a Freudian slip. We have to divide by scale, which is price. Okay, so now let's look at the return earnings regression, which I advocated in both of the papers that I've just talked about, yet is not without its problems either. Okay. Now, I could have done this in a Haynes-style regression. I could have done this in a generic Easton-Harris type regression. Why did I choose Bassy? I choose Bassy because I think this is a regression most of us tend to run these days if we run an earnings return regression. And there's an economic story as to why this mapping here from negative returns to earnings, which is the Bassy coefficient, why that thing might be driven by the same things as drive the mapping from the denominator to the numerator in returns and the denominator to the numerator in earnings. Okay? So this is the regression that many, many, many people run. Okay? And don't misinterpret me. I could have done exactly the same analysis with my own regression, Easton-Harris. So I don't mean to pick on this guy, Bassy, at all. It's just a nicer pedagogy. Okay. Now, what Sadipta's interested in, what Ball, Cathari was, what all of those guys are interested in, is the mapping from negative returns to earnings. And the argument is this thing picks up timely loss recognition due to all kinds of things, and this coefficient should indeed be bigger than the coefficient on positive return, so the dummy should kick in as significant. That's the whole story, right? Mechanically in the econometrics. But I would argue, and this is a paper with Lawrence Van Lent from Tilburg and Valerie Nikolaev from Chicago. We argue that the mapping from price, the denominator, this thing we divide dollar returns by, to dollar returns, is driven by the same things as drive the mapping from here to here. That becomes a real problem. Because when you scale, you're going to possibly throw the baby out with the bathwater, or alternatively, you're going to spuriously induce something into this coefficient that shouldn't be there. Okay, so we've got to worry about this mapping when we divide by price. And that's the moral in the story. The moral in the story is if you divide by price and it affects the coefficient of interest, you'd better worry about it. And we talk about how you might be able to deal with that. Now, the story's not done in as much as this thing we call price change asymmetry, and I'll talk about that in a minute, that affects the mapping from prices to returns will also affect the mapping from price to earnings, particularly if we buy the story in Bassy, which is, or the question that Bassy tries to ask is earnings a good or a bad summary of the news that's hit the market over the period? And as you all know, he suggests that earnings is going to be better summary of bad news than of good news. Okay? All right, so somehow we have to unravel that effect. Now, what is this thing called price change asymmetry? In other words, what is it that will cause a different mapping from scale to dollar returns that we need to worry about? What will affect that mapping? Okay. Well, here's basically our argument. The argument is if you've got, if bad news hits, the impact of bad news is going to be different to if good news hits. The impact on dollar returns is going to be different. After all, if you own a stock trading at the average price of US stock these days, and we'll say it's $1.50, it's nice for my example. If US stock are trading at $1.50 and you own one of those stock, you cannot lose any more than $1.50. That's it. But you could gain hundreds of dollars, right? The price can't drop below zero, but it could rise to $250, right? In other words, we've got this asymmetry. It's as simple as that, right? So what we're saying is that the mapping from prices to positive returns is different from the mapping from prices to negative returns. Okay? Similarly, the mapping from prices to losses, after all, price very low, earnings very low, how much lower can they go, right, before you abandon the firm? Right? And of course, we've got all these stories, agency-related costs and abandonment options and all that stuff that you're all aware of. But how much lower can they go? So the mapping to negative earnings is going to be different to the mapping to positive earnings. So we've got this asymmetry in the relation between the scalar and the measure of change in value, earnings, and between the scalar and the measure of value change. An actual value change. Okay. Now the question is then, how would you deal with it? Well, here's a suggestion. And it's only a suggestion. Well, it was, but it's disappeared. Here it is. What we did was we simply run a regression of dollar return on price. And what we see is that if we've got positive returns, the regression pattern, which is this blue line, is very different to the regression pattern if we've got a negative line. You look at this and you say, that doesn't look like a regression to me. It is a regression, but it's a non-parametric moving regression, where at each point in time, the points around influence this point, and so it's a smooth regression line, not a straight line. Okay. Now, a measure of price change asymmetry is at any point, any price is zero returns. We just take the difference between the positive side and the negative side as a measure of asymmetry. In other words, on average, if price is sitting at, we'll take an easy number, $1, okay, price can rise from $1 up to about $1. In other words, it can double. Or it can drop to 40 cents. Okay? And so that ratio is a measure of price change asymmetry. So what do we do then? And you can appreciate what we do. You can guess the next step. What we do is, and I'm sorry these slides got out of order, what we then do is just see what the impact of price change asymmetry is on every one of the Bassy coefficients. This is the Bassy regression, by just adding all of those variables interacted with price change asymmetry. So if we still get a significant Bassy coefficient and we've measured this price impact correctly, then we're fine. Okay? In other words, we recognize we have to scale. We recognize scale has an effect. We're going to control for scale and see if Bassy still holds. The good news is it does. Okay? So here is the result of running the Bassy regression that we all do, or many people do. Okay? And here's the Bassy coefficient. So the coefficient on negative returns is 0.36. It's higher than the coefficient on positive returns, and it's significant. Okay? So people would say, conservative accounting. Okay? Timely loss recognition, whatever they want to call it. Okay? Now, after controlling for the asymmetry, we still get the significant coefficient. Now, it could have been, and this, of course, would be the fear if you go into this analysis and you're doing a Bassy-style study, that, in fact, when we control for scale effects, then this coefficient would go away. Okay?
I just have a question. For a company that for the first time experienced a negative return, is the price reaction likely to vary from a company that the past 5 periods were negative return? How can this influence the...
Yeah. What Ahmed just said is, this measure is incredibly crude and he'd like me to refine it. It is incredibly crude and it would affect it. In short, and I'm being a bit flip in the answer, I don't mean to be, well, I think I do mean to be, but don't be offended. We've got to do our best we can to control for the scale effect, and I'd be the first to suggest that it's not perfect, and you've pointed out the way it's not perfect, but I think we've got to do the best we can. Now, similarly, at a very crude level, it would be pretty obvious, wouldn't it, that if we just divide through by scale, why wouldn't we just add scale as another variable in the regression? And if that impacts the results, we're in trouble. And notice that's all we've done here. We've really just, in a somewhat sophisticated way, added scale as another variable in the regression, impacting every one of the variables. Okay? But I think at the very least we ought to control for scale. So if we divide by scale, just add 1 over p as another variable in the regression. And don't misinterpret me. I'm not saying in a heteroscedasticity sense. We're not running weighted least squares with the inverse of p as another variable in the regression. It really is there to control for whatever it is that price is picking up, which may not be controlling for varying residuals. So the message is scale does matter even in the returns regression, so let's not think it does. It doesn't. But I think the response is, let's think about how it affects the return regression and control for it. That's hopefully the takeaway. Lastly, and I'll be brief about this so that we can kind of get back on track a little bit, because I talk about this again tomorrow morning. But scale, I believe, has had a big impact on our misinterpretation of the threshold, earnings threshold, management of earnings around the threshold of 0. As you know, there's a vast literature that comes from this graph. Many of us, and the major textbooks in accounting, many major textbooks in accounting, point to this graph and say, look, there's earnings management at 0. Okay. And what is this graph? What this graph is a graph of varying intervals of net income as described in the paper, but what is not described or talked about in the paper It is net income divided by beginning of period market cap. Okay? And the division by beginning of period market cap is what causes that kink. And you'll see tomorrow, or you will have seen if you've read the Durkee Easton paper, I'm presenting a different one tomorrow to the one on the 2005 paper. But we demonstrate tomorrow, I hope I convince you, that if you run this graph, or do this graph undeflated by price, you don't see the kink. If you deflate by price, you do see the kink. And then we have to say, well, why do you see the kink, and why is it due to price? Well, at a crude level, this is a plot of the price per share for every earnings per share interval ranging from -$1 to +$1. So these are pennies per share intervals. Okay. Now we've got the distribution ranging from the 95th percentile, this top blue line, to the 5th percentile at the bottom navy line. We've got the entire distribution. If you focus on any one of these lines, and perhaps the most important one to focus on is the median, which is this purple one, what becomes very obvious is that price per share to the left of 0 is very, very different to price per share to the right of 0. And of course, right, you'd expect that to be the case. You would expect price per share for firms making losses to be lower than price per share for firms making profits. So if when you create this Berkshire graph, you're dividing losses by a smaller number than the number you're dividing profits by, what you're doing is you're pushing the numbers to the left of 0 away from 0, and you're sucking those to the right of 0 in towards 0. And hence you get this step here. Doesn't explain that peak, I'll explain that tomorrow, but you do get this step. So these are sucked away. These observations are pulled in. Okay. Now just to see how dramatic that is, here for a penny positive earnings and a penny loss, 2 penny positive earnings, 2 penny loss, 3 penny positive earnings, 3 penny loss, and the whole range, 4 cents to $1, minus 4 cents to $1. We've got the mean and median price per share. And this is pretty dramatic, right? The median price per share, if you make a penny of profits, $1.31. Median price per share, if you make a penny of loss, is 25 cents. So we're dividing profits by a number that is 5 times the number we're dividing losses by. No doubt we're going to suck these things away from 0. We're going to pull these things into 0. The effect's dramatic. It's not just at the margin. Okay. You can look at other variables. Here's market cap. Same graph for market cap. And again, if you look at the median line, this magenta line, you can see the same picture with market cap. Okay. And just as an example with market cap, in the interval 0 to $100,000 of net income, the average market cap is 4.36 million. You divide 100 million by 100,000 by 4.36 million. You get an average of 0.02. In other words, these are in a cell real close to the y-axis. Here, the average market cap is 2.67 million. In other words, you're not sucked in as much as you are to the right of 0. Again, this number being less than 1, you are sucked in, but the sucking in to the right is greater than the sucking in to the left. So market cap has a gigantic effect, or more importantly, scale. And I'm going to go through these real quickly, but you'll see it doesn't matter what variable you look at, market cap, net operating assets, net sales, number of employees, total assets, shareholder equity, number of shares outstanding. Every one of these things is different to the left of 0 than the right of 0. And I guess that makes a lot of common sense. and that even number of employees, nothing to do with size of the firm. If you're making a loss, chances are you're not recruiting. If you're making a profit, chances are you are recruiting. So number of employees even, it matters from left to the right of zero. And this last point needs to be made because there's a troublesome number of papers that say market cap's not a problem, so I'm going to use total assets or I'm going to use sales revenue. Well, not the answer. It's still going to be a problem. So the answer is, if you want to do management of earnings around a threshold, the answer is to make sure that the scale is the same on the left of zero to the right of zero. If that's the case, you're fine. And a very nice example of that, there is one example. It's by Jan Bowens and... Jan Bowens is one of the authors, and I've forgotten his co-author at this point in time. Jan Bowens from Tilburg has a very nice paper where he looks at earnings management for hospitals in the Netherlands going up for government funding. And the point, of course, he's trying to make is that every 3 years, the year they go up for money, they're not doing very well. Okay? In other words, they're making losses, whereas in the other 2 years, they're making profits. Surprise, surprise. But then he's got a problem. He's got big hospitals and little hospitals. Okay? So he divides by number of patients. That's his scale variable. That makes a lot of sense. They're private hospitals, so he can't have market cap. He can't do that. Number of shares he uses. And what he finds then, he does this really nice check. He says, shows that number of employees if you're making a loss is not different than number of employees if you're making a profit. So you sort of check that you've got a scalar that's not affected by the variable, the phenomenon of interest. Okay? So what's the conclusion of this somewhat briefer session? Scale matters. That's it. We must pay attention to scales. And all too frequently, I think we see that we don't pay attention to it. And, you know, papers slip through the process. An incredible number of papers slip through the referee process that have scale issues. But it's incredibly risky. And sometimes someone's going to say, hey, this is all due to scale.
I just have a question. Let us just assume that my dependent variable is not market capitalization. And I perceive the scale problem as an omitted variable bias. Will be a difference between deflating and putting the scale, or alternatively putting the scale as an additional independent variable?
Ahmed always asks the million-dollar question. And the million-dollar question he just asked is, let me put it a different way. Barth and Caliper make the point that a way that you might control for scale is to add scale as another explanatory variable. And I made that point in the return regression where you might add 1 over p as an additional variable, right? And so I agree with that in principle. But then if you argue that scale is market cap or scale is price per share, it makes no sense whatsoever to add market cap as an additional explanatory variable when market cap is the dependent variable, or price per share is an additional explanatory variable when price per share is the dependent variable. Then you have to argue along the lines that Ahmed just implied, and I'm putting words in his mouth, but he implied that market cap may not be the appropriate variable, so you would put some other scalar in there. If you can argue that convincingly, that's absolutely what you would do. But it's an incredibly hard argument to make. Particularly, and remember what we're trying to do. When we're running these regressions of price per share or market cap on a whole bunch of financial statement variables, we're basically saying market cap is the measure, right? And we're benchmarking book value and earnings against that measure. Well, what's it measuring? I think it's measuring the size of the firm. So what we're doing is we run a regression of scale on scale on scale on scale. The best measure is the left-hand variable, price. Book value is not so good, but it has explanatory power because it's a sort of measure of scale. And earnings picks up what book value doesn't pick up, and vice versa. Okay? So I think the answer to Ahmed's question, which is a very good question, could you add scale as another variable? Only if it's not the dependent variable.
I don't understand why, I mean, if you believe the economic heuristic in terms of efficient markets and you believe that prices can deviate from the value, right? Why do lot more error by deflating by something, and not for your particular application, but more generally.
Well, I mean, the question is, paraphrasing the question, but the question is, if you've got, price is not the be-all and end-all. Price could be a bad measure, particularly if you believe that the market, or think that the market might well be inefficient. Good point. But I, as an accountant, would be very reluctant to say that book value, just because it's measured by accounting, and objective and all of those things, is indeed a better measure than market cap. In other words, taking into account all the warts that market cap has, still it picks up scale better than any other measure. And even in an inefficient market, it is the value of the firm as perceived by the investors, even if it's foolishly perceived by the investors. But you can see that this point about what is scale is at the heart of the whole argument. If you can argue, or you believe philosophically, and this is a philosophical debate, if you can argue that scale is something other than market cap, or you just think that it simply isn't market cap, then most of what I've said is moot. Right? In other words, it rests on market cap being pretty much scale, or very closely related to scale, or the very best measure you could have of scale. I think it's really hard to argue against that, but not everyone agrees with me.